Hey folks, Shawn over at the Annuity Expert. In today's video, I'm going to give you some pretty blunt advice. If your financial advisor gives you this advice, then you need to fire them immediately, or at the minimum, go do this on your own and against their advice, because it's frankly some of the stupidest advice I've ever heard. I've been through this through family members of financial advisors have said this. The two insurances are life insurance and long-term care insurance, and I'm going to show you today the significance of that. So if you're nearing retirement or are already retired, if your advisor who dismisses life insurance or long-term care insurance without analyzing the financial consequences may be ignoring two of the biggest risks to your retirement plan: the death of a spouse and the cost of extended care. Okay. When a financial advisor is telling you that you don't need insurance, it's not automatically giving bad advice. There are, retirees out there who can legitimately self-insure. People who no longer need life insurance, or people whose health or financial situation makes certain coverage impractical. The red flags is something different. If your advisor says, if you have enough money, just go self-fund it. I mean, the analogy I use is, if you go to let's say you're shopping for a Honda Civic, right? We all know what a Honda Civic will cost. You go to car lot A and it charges $25,000 for the Honda Civic. And you go to car lot B and you get they have the exact same Honda Civic model, and they charge $80,000. That financial advisor just told you that it's okay to go spend $80,000 on a flipping Honda Civic, right? That's the advice there. So whether you're high net worth or whether you're just middle of the road type of person, that's the bad advice that is being given to you, okay? Saying that you have enough money, man, part of a financial advisor's job is to help you save money, not manage as much money underneath their portfolio. Manage more money in your portfolio so that they can charge you higher fees as their commissions. That's not all of their job. It's saving money on taxes. It's saving money in general. It's protecting a surviving spouse. It's protecting your designated children, right? So when you look at this, it's not cheap, but it's also not out of range for affordability, right? If you're living on a fixed income, okay, well, you kind of have to pocket as much money while you're alive as possible, right? And getting life insurance might not be affordable at your age. And by the way, you can get life insurance up to age 85. They make specific policies for that. And then for long-term care insurance, if you're on a fixed income and watching this video, you probably can just get into the state's Medicaid program. For those of you that don't know, Medicare does not cover long-term care, and Medicaid, you have to spend your assets before you can be eligible for your state's Medicaid program. Last time I checked, y'all don't want to spend your own money toward nursing home, assisted living, or home health care just to get to the state's program, right? So you gotta think about the workarounds here. So if I'm looking at a surviving spouse, the way I'm looking at it is from emotions, right? So let's just say, man, you guys are doing well in retirement. You die. Your wife or husband, surviving wife or husband, is going to have to make adjustments. The obvious, you're not around and they're grieving, but also if they have to take a cut in their cash flow, or recalibrate the finances, which is a topic most people stick their hand in the sand or procrastinate on or ignore completely. So now you're going to set up your surviving spouse in a situation when you die that not only do they have to grieve that you're not around no more, they have to make their lifestyle going forward with them being alone. And then they have to make adjustments financially. A lot of people we talk to surprisingly don't have life insurance. And the people that we talk to are 55 plus, right? and they don't have any sort of life insurance, which is mind-blowing because it's basically you as the spouse saying, hey, it's okay if I fuck my surviving spouse over with when I die. Sorry for the language, but that's what you're doing, right? You're setting your surviving spouse up for disaster, right? Especially if you don't have a lot of money saved up or an investment portfolio. Why would you put your spouse in that position? Shame on you for doing that. But the reality is that's what happens. And if you have a lot of money, you have over $1 million, shame on you even further. Because you can afford to go buy some sort of life insurance for that spouse. And even if it's expensive, it's worth it. It's worth knowing that you've made your surviving spouse life easier and have a smoother transition when you go than the opposite of not getting it, right? So get life insurance. You can come over to our website here, under our calculators, and you can run it anonymously. It's not going to be cheap because you've waited this long and you're probably over the age of 55, but it's better than nothing. It's better than not having life insurance out there. And you can utilize us as your independent life insurance broker to help you find the best policy at the lowest rate, right? So, but if your current financial advisor says, you got enough money, you don't need life insurance, shame on them. Part of their job is to help you do generational wealth and save money. Not everything is about investments. Not everything is about investing. Not everything is about earning a management fee off of your money in the market, right? Moving on to long-term care. This is to protect your money while you're alive, right? So the government says that you have a 70% shot if you're over 65 at going into some sort of home health care service, assisted living facility, or a nursing home. I want to talk to you about costs here. National average, this is the average, $86,909 for long-term care services and facility. If you go here, informal care, this is a friend or family member, it's going to cost your friend or family member about $83,440 a year in 2026. Home care is when you hire a professional to come into your house, do chores, bathe, basically take care of you at home. That's going to cost you around $78,421. Assisted living, it's going to cost you $70,349. Nursing home, $115,428. That's the average. Now, I want you to think about your current lifestyle. If you have more than $1 million saved up, you have a standard that you live. Your cost of living, the way you live your life, your bills, your home, your lifestyle, traveling, all those nice comfort things that you have into your lifetime because you've worked your ass off to get that sort of comfortability, if that's even a word. You're not going to want to go into a middle of the road nursing home. You're not. You're going to want to go somewhere nice. This $115,428, it's likely going to be $150,000 or more a year, right? Now let's look at the projected future costs. Let's go 10 years in the future. Let's say you're in your 60s and you're thinking about maybe it might happen in your 70s. And by the way, if your parents or family members have had dementia, Alzheimer's, Parkinson's, something like ALS, man, that should be your red flag. That should be your warning sign right there. I need to get this. I need to get long-term care insurance. All right, so if you look here in 10 years, the projected cost, this is your friends or moving in with a family member. So you're moving in with your children, $108,871, $102,322. Assisted living, $91,789, and then $150,607. It's only going up, right? Just like medical insurance expenses, right? You go to a hospital, it's going to cost you out the ass. You go to an ambulance, it's going to cost you out the ass. You get cancer and you don't have good Medicare coverage, it's going to cost you out the ass, right? Same thing with this, except for Those are short-term fixes. These are long-term fixes, right? And here's the thing. A lot of times you sign contracts, you go into facilities where as you need more assistance, let's say you have Parkinson's, as it progresses, if you're in your 70s, your healthy spouse may not be able to get you out of a wheelchair, right? And so you need somebody strong enough to get you with those conditions out of that wheelchair. Well, when you need those 24/7 assistance, it's going to cost you more and more money. And then you're kind of trapped in these facilities in a sense that you don't want to leave because the problem's only getting worse and you're only getting weaker and you don't know if you can do it on your own. So you end up blowing all of your money in these facilities. So if you have $1 million, you could see $150,000 eating into your investment. And if you're a child of a parent in this situation, that is your inheritance going bye-bye because they didn't get this insurance. Okay, so let's talk about the insurance. You could go and you could get traditional long-term care insurance, but here's the horror story around it. The idea is that it's already expensive when you buy it, and as you age, it gets more and more expensive. And then what happens is if you don't use it in your late 70s into your 80s and 90s, the premiums can skyrocket to a point where it's no longer affordable. And then it forces you to cancel the policy, losing all those premiums. And then you're back at the beginning in terms of your long-term care journey, right? That sucks. If you use it, okay, fine. But if you don't use it, and then if you die, those premiums all get lost. It's just like car insurance, okay? So what are the solutions? Well, you could go buy a long-term care annuity. A long-term care annuity will do one of two things. They'll either they'll double your lifetime income if you use an annuity for your income for the rest of your life. So if you're getting $50,000 a year in annual income from your annuity, it will double to $100,000 to pay for these things. Or you can get a true long-term care annuity, not a long-term care rider. And that long-term care annuity basically will either double or triple your investment to pay for these expenses tax-free. So for example, if you put $100,000 into a long-term care annuity, it will be worth instantly $200,000 or $300,000 of long-term care benefit that can be accessed tax-free in most scenarios to pay for those things. And what happens if you don't use it? That $100,000 that you put into it goes down your beneficiaries in a lump sum. And you could put your spouse on both of those types of long-term care annuities. So two lives on one policy. The other option that you can do is you can go buy some sort of life insurance policy that has a living benefit attached to it, where you could tap into the death benefit while you're alive to pay for chronically ill conditions, stroke, heart attack, Parkinson's, dementia, Alzheimer's, right? Or they have these, what they call hybrid long-term care life insurance policies where the death benefit sucks, but the long-term care benefit, it's pretty good, man. I mean, we're talking $4,000 or $5,000 a month benefits that you could use towards a nursing home. And that will scratch the surface. That will put a dent in the cost. And if you don't use it, just passes down to your beneficiaries like a life insurance policy. So those two examples there, you can utilize either a long-term care annuity or a long-term care life insurance policy. You could cover your ass financially for future long-term care costs. And if you don't use it, it just will pass down to your beneficiaries as a death benefit. And it doesn't become a scenario of money being lost to the insurance company, right? And if you have money already in your head that you want to leave as an inheritance, why don't you just put it to work while you're alive? You could do this method, these hybrid long-term care products. And if it doesn't use it, it just goes down your beneficiaries, right? So it's protecting you while you're alive. And in the case that you do get one of those debilitating conditions, it protects you from spending down what's already your children's inheritance, right? So if you've allocated $500,000 or a couple $100,000 or whatever to your kids already in your investment portfolio, Your financial advisor may say, hey, well, we'll just keep growing it. You could self-fund this, right? You could pay $80,000 for a Honda Civic. No problem. You got enough money. Well, once you get those conditions, nobody's going to insure you. You're screwed. And so now that money that you've kept with your financial advisor, who is making a fee in a good or bad market on that money, because they're trying to make as much money as possible because they're salesmen just like everybody else in this world, you're blowing their inheritance. You're blowing where this at least gives you a fighting chance at protecting those assets. You're in a facility for 2 years, 2036, you're gonna blow $300,000 or more on a facility when you could have cut it down to a third by using a long-term care annuity. I mean, sorry, but I wouldn't do that. So if you're in a position where you're with a financial advisor and all they really want to do is invest your money, grow the portfolio, fingers crossed, roll the dice, hope it's all is well, and say, hey, you don't need to get life insurance or long-term care insurance, fire them or peel money out and do it yourself, because that is awful advice. And it has happened, and it has happened to me personally. So hope this helped. Catch you on the next video.